All right, good evening, gentlemen. And well, I'll cover my base. It's good evening, ladies and gentlemen. This is Clueless Trading Frank. Today is January 17th, 2017. I'm still stuck in 2017. I'm sorry, I'm still stuck in 2016. This session is a free market update webinar, some strategic forecasts on the U.S. financial markets, and specific trade alerts and charts that I deliver to my members and free trial subscribers. The session will be recorded and uploaded to the Clueless Trading YouTube channel. Highly suggested that all of you subscribe to that particular channel, so at any given time, if I put any one of my video casts up there, and each of them are quite important to what I do, then you will be automatically notified via your email through YouTube notification. Full disclosure, this is purely for financial education and not for any solicitation or advice. So let's kick off this evening, and for the next 60 minutes or so, I'll try to cover some important aspects of what's happening with the markets, and hopefully it's going to be very helpful to you guys as we go into the remainder part of January and going into February. A couple of quick, while I'm speaking, what you see in the back is the Quad, the platform that I use, what I call the Algo HFT version, which is a very, very precise and somewhat algorithmic depiction of market movements. Allows me to be very timely and pinpoint the inflection points when the markets are turning, and primarily allows me to handle the volatility so that I can alert all of you on a real-time manner, so you guys can take advantage of and protect yourself on these surges of buy and sell programs that hit the market on a daily basis. So saying all that, a couple of important points I want to cover. One of the key things about 2017, which I reminded everyone at the latter part, I believe on my last video cast and the one prior to that, and I mean what I say, is we are going to encounter a level of algorithmic volatility that many of you are just not prepared for. And it is I've always said, and I'll stick by it, that these markets are driven on a given day. More than 80% of the trading volume is machines trading the market. So what we are basically doing is trying to handicap what's coming in front of us and hopefully catch the pump and dump buy and sell programs that hit the market on a hourly basis, if not, I'm not going to say minute by minute, but on a 30-minute and hourly basis. We are constantly seeing surges back and forth. So very, very critical, and that's why I do these market webinars. And of course, many of you are enrolled in the ACS programs, the Advanced Coaching Session programs. I walk people through it. And this was a long weekend, so I didn't get a chance to really do any, but I certainly will be diving into it this week. And I explain every single nuance of what we might expect and how to read these very, very tactical charts so that the surprise element in the market is minimized. And I can assure you that 2017 is going to be the year of extreme volatility. Extreme volatility. 2015 was, 2016 was, but 2017, in my opinion, from my experience of doing what I do, I believe that it's going to be, to say the least, very volatile. So saying all that, one of the simplest way that I can suggest that all of you handle the volatility and manage your trades, because it's all about trade management, to be honest with you, is to try to understand and read the charts that I'm putting through in a manner that will help you. And the more you understand all the different and the correlations and the movements of all the different lines and indicators and stuff like that, the better off you will be. I'm not, as I've said before, my business is not to make somebody a PhD in technical analysis. I certainly am not, but at least you should have a working understanding so that you can take action appropriately on what you're doing with your trades. So saying all that, tonight I'm going to focus on the quad platform that is in front of you, which I call the Algo HFT platform, and walk you through the basics of what you should be looking at when I post these charts up. Now, it is extremely important, of course, that you also have your own screens behind you, in front of you, so that you can see and match a lot of the stuff that I'm showing and the levels that I'm posting. Some of you are using Quad and doing and handling stuff a lot better, and some of you are using different platforms, which is completely fine. Even though I highly recommend that people at least do a trial version of this Quad platform. And the full disclosure, this has nothing to do with me. I have no stake in Quad. It's just a platform that I've been using as one of my 3 different charting venues that I use, and I've been using Quad for more than 8 years now, if not more. So if anyone's interested, reach out to me and I'll send you the link. You can talk to them directly. They have a very, very discounted rate on this platform, and once you get the hang of it, trust me, you're not going to leave it, because it makes a lot of money and it saves a lot, especially during intense volatility. That's really what it's designed for. So let me just a couple of quick points about the market. Aside from the volatility, we are about to embark. We have embarked on the earnings season. Fourth quarter earnings that are being delivered right now, fourth quarter of 2016. Retail traders in general are always fixated on actual EPS, earnings per share, and that type of stuff. But the reality of this particular earnings reporting season is that it's all about the guidance. It's all about what they think, what might be coming in 2017. We have had a whole regime change on the governmental side, i.e. the fiscal side, and that is obviously being played out in the market, what we call the Trump rally, and the animal spirits that have gripped the markets to a certain degree. So it is extremely important that company managements that are reporting how they are explaining and what they see. If you start to feel a level of optimism, that stock, regardless of what it does after hours, will go higher. That's just the way it is. Given the fact that the volatility algos are constantly moving in and out of the markets, mostly in the markets, back and forth, what happens the night before during earnings has almost no bearing on what will happen on the following day when the market opens up. That's just the nature of the business. And so having a somewhat black and white view that, oh, they had good earnings and the stock's up and it's going to continue to go higher is not going to cut it. Because the stock can spike up 10, 5, 10, 1, 10, 15, 20, 30 bucks, depending on the type of stocks, that are delivering the earnings, but then it might give everything back within seconds, if not within minutes of the market opening, or even after hours. So the guidance is really what it's all about, and that's something you all have to keep in mind. The second thing that I always remind my traders and members is, please do not try to be an analyst. And I say that with humility. I was on Wall Street for more than 14 years. I understand fundamentals and the dynamics of what a certain company is doing, especially the companies that I track and follow and the sectors that I know well. And I can assure you that looking at your standard run-of-the-mill PEs and all that garbage, to be honest with you, means nothing. It really means nothing. So trying to be very analytical about dissecting a income statement or a or the revenues or the multiples on a particular company is not going to help you whatsoever. You guys have seen that happen over and over and over again. Great earnings, stock falls. Somewhat weak earnings, stock just ramps up. Look what happened with Chipotle, one of the preliminary numbers. So I can give tons and tons of example of that. So just as a matter of helpful suggestion, please do not try to be an analyst. Try to read the markets as much as possible by the help of these tactical charts that I'm posting, with the help of what you are doing on your side. A combination of that will help you make more money than trying to sit there and dissect, what the numbers delivered are. And that you will see that is the case, and more so now than before. Markets are being swayed by many different factors. The simple theory is that by the election, which no one did, to be honest with you, we did. And that's the reason, more than, as I like to say, as a figure of speech, that 90% of traders basically never really made any real money from the rally that from the Brexit. I called it the Trexit, the Trump exit after hours on election night, and then the turnaround, massive hammer reversal from the bottom. It's most traders and most institutional managers included did not capitalize on it. So what's happening is, from a behavioral standpoint, is everybody's just, a lot of people, a lot of traders, especially pro traders included, are all praying for some sort of massive pullback so that hopefully they get cheaper prices. Except the problem is with the markets that when the pullbacks do happen, tactical pullbacks, as I'd like to call them, because the primary trend of the market is still an intermediate bull market, whether one likes it or not. So bottom line is that when the pullback comes, they don't buy. It's happened over and over again, even within our group. 2 Fridays ago, which was the end of December, the last day of the year, markets falling apart, all kinds of stuff. I believe it was right here. And my indicators were starting to show some very deep oversold conditions, some positive divergences on the internals. Place positions on the long side. The markets opened up 18 S&P points higher on January 3rd. Right there. You see that. That was more money made and possibly closed the books for the month, to be honest with you. Well, I'm exaggerating. I wasn't that overloaded with long positions, but I had some very, decent ones, and many of you did too. And right after that, we had a massive reversal, inverted hammer. Right there, you can see that. And then the people who chased the market right here basically got clobbered. They probably sold right here as the stops got triggered, and then the market decided to go its merry way higher. All these internals were clearly showing that we're going to go higher, because despite this pullback, the slow stochastics, which I'll walk through briefly today, and I talk about it quite a bit, continue this trend movement higher, despite this sharp pullback. This was a very sharp pullback during the day. It started around 10 a.m. and pretty much ended here at 11 a.m. 30 minutes. In algo time, that's like 10 years. Okay? So, which brings me to another very important and critical point. And these are just my thoughts. Looking at prices alone is not going to do anything for you guys. If you think you're going to be a price chaser, good luck. And you've tried to do that many, many times before. And these algos are all about fake breakouts and fake breakdowns. And you've been clobbered. So reading a combination of prices, as in the form of the external chart, the candles, reading a combination of these very simple fast stochastics as the top column, the lower column is the slow stochastics, which is really the more of the swing trade time frame. Whether that swing trade is a bunch of hours, whether it's a day or two, the reality of the situation is that if you're just looking at prices, you are not going to make it. And you're not going to make the big money. And you cannot be consistent. Yes, you'll catch some good trades here and there by chasing prices, but you're never going to make the real fat triple-digit type of returns on the weekly options or the monthly options and things of that sort. So price combined with internals is what it's all about. Factors that are dominating the market right now is obviously the inauguration of the president-elect Donald Trump on the 20th, which is Friday, which also happens to be. Can somebody tell me what Friday is? Aside from the fact that it's Friday? Just take a shot.
Options expiration.
What was that?
Options expiration.
Yeah, but what options expiration? There's options expiration every week.
Triple witching?
You're missing one important point. Yes, you're correct. Monthly options expiration. Exactly. So monthly option expiration, triple or quad witching, not sure which one it is. But more importantly, it's monthly options expiration. And what happens during monthly options expiration, 90% of the time, you get some sort of, it's normally has a positive bias. Normally has a positive bias. And it doesn't have to be all day Friday it's going to have a positive bias. It's leading up to it what normally has a positive bias. Because generally by the second part of the afternoon on Friday, as they're winding down, as the market makers, which nowadays are basically most of them are machines, the black boxes, are winding down the options expirations and pinning the strikes and doing all that stuff, it normally kind of fades. So it's the first part of the day where most of the money is made. But you have to position yourself earlier than that. The positioning has to be done on a Wednesday. Generally, Wednesdays are reset days, which are sell-off days, but this being a shortened week, what I have seen is that the Tuesdays are somewhat like the reset days, and sometimes Thursdays. So whichever the case, there's no way of telling. So relying on what I see in my technical charts on many different on different platforms, on the Quad, on the Thinkorswim, on investing.com, I try to make a determination. But generally speaking, monthly expiration, it has a bullish bias. Now, I don't know exactly off the back of my hand whether or not we have a large open interest on the SPX or SPY calls or puts, but from what I can see from the outside, it seems like the overall bearish bias, given the fact that it's going to be a crash on the 20th and stuff like that, is the bias is mostly on the put side, on the bearish side, and you certainly hear that in the media, and you certainly feel that when you're looking at the other forums, where traders are posting their thoughts and their charts and stuff like that. Whichever the case, once the 20th is, once we cross over that, we only have 5 more trading days roughly left for the end of the month. If the market plans to, which I believe it will, post a positive January, because I believe that the market wants to send a signal that they believe in the new administration's fiscal policies and their plans on rejuvenating and spurring the U.S. economy. I believe from a predictive game theory standpoint that the markets will send a positive signal and end January on a positive note in the plus zone. And that old saying says, how January goes the rest of the year. Well, if somebody is kind of like, if that's the psychological message the market wants to send, then the powers that be that control the market will post a positive number for the month of January, and we will end on a higher note. Now, saying all that, the thing that I want to point out to everyone, which I say all the time, is don't expect a straight line up and a straight line down. And you start expecting that, it's not going to help you with your trading or help you in making money. There's going to be intense intraday choppiness. We saw that today. And we see it every week. and there's certainly going to be there's certainly going to be a sudden impulse sell-offs and surges in prices when we're least expecting it, and that's just the nature of the beast. There's no way around it. So it is extremely important to try to maximize what you have in front of you, and look at some of the patterns that are shaping up, not necessarily on the 5-minute or 15-minute charts and such, but more so on the hourly charts. And I posted quite a few of those, and the inverse head and shoulder, which is a bullish pattern, seems to be still intact, and we'll go over that tonight so you guys can see it too, even though all of it is posted on the real-time Twitter feed. And for some of you newer people who have come in, you know that all the stuff is out there, and I even put it out there. I mean, wrote in big letters, inverse head and shoulder still intact. So between these convoluted moves that we see in the market, which is basically volatility, we are sorry, as I'm talking to you, I'm adjusting some of these charts. We are going to I still see a pattern, even though they're complex and they're not that easy like we see, when we're doing our when you're looking at a simple head and shoulders or simple inverse head and shoulders, which is bullish, head and shoulders obviously bearish. There's a lot of patterns developing within the intraday basis, within an intraday basis, and of course the broader pattern is always there. But the broader pattern is not going to make you the money. Now, why do I say that? The broader pattern, which is the daily and the weekly, is fantastic. But unless you're taking a swing short or so, giving an example, and want to sit on something for the next 2 weeks and hold your nose because the markets are surging up 100, 150 points from nowhere, but you're still on the belief that yes, it is a head and shoulders, it's a rolling top that it looked like on Friday, stuff like that, then fine, that's your prerogative to do that. But guys like us who have both swing, intermediate, and short-term trades, we need to make money almost every day. So it's up to the person. If you want to make a macro bet that the markets are going to come down hard, then feel free to keep on shorting. I do believe that February is going to be pretty choppy after we wind down January. But before that, we could still get that wave 5, the end of the wave 5 move, which could carry us all the way, which we're not too far away from, into the 2300 range, which is right around the corner. It's only 33 S&P points from here. That's roughly about 200, 180 to, about 200 Dow points from here. And that could very easily happen. That touches that psychological number of 20,000. So all that stuff matches. So, the other major volatility factor that's entered the market since good old Donald loves to tweet are these tweets that keep on hitting the market. Today's one was that he thinks the U.S. dollar is killing us because it's it's so strong. Which is, I don't think it's killing us, but I kind of agree with them that the U.S. dollar needs to be weaker for many different reasons. One, it helps our exports. Two, it helps emerging market debt, which is all priced in U.S. dollars. Okay, then it's not priced in rubles. It's not priced in Chinese yuan. It's priced in U.S. dollars because we are still the king. The dollar is still the king. So when the dollar is sky high, you're going to see a lot of internal pressure on emerging markets to service their debt. And that's not a good thing. So what Trump said, he's right. Okay? So the dollar fell, and the DXY, and it's at 100.24 right now. Breaking 100 would be a very serious thing. So that impacts the market somewhat, but it also helped the commodities, and people like us, and I'm sure some of you who were long gold through JNUG and Nugget had a phenomenal day. And it looks like gold is still going to go higher. I've posted some gold charts across the board, and it's very clear to see where I think it's going. I think gold futures are going to about 1220, 1240. 1220 is already there. And I mentioned that when gold was turning from about 1120, 1130. It's 100 points higher. So the weaker dollar, so that Trump tweet today caused a little bit of havoc in the currency markets, and then you had the external pressure coming from Europe because of Theresa May, their prime minister, making a hardcore speech about the hard Brexit, not a soft Brexit, but a hard Brexit, which causes a lot of anxiety with a lot of multinationals who are based in England, in London. Okay, so there's a whole bunch of things that kind of like swept the markets today. But even through that, we managed to tactically make some very decent money on certain things, even though net positions were slightly flat to down, depending on what swing trades you're doing. Not gold, that did phenomenal. So let me walk you through. So saying all that, that's the backdrop in the market right now, and expect to see a lot of the global markets when they open tonight to feel the after effects of our pullback. Even though we ended the day down 58, we were down more than I believe we were down. Were we down more than 100 points at one point? I can't remember, but so expect to feel that in the foreign markets. Second thing, earnings. When it comes to earnings, there are obviously a couple of the big kahunas who control the shots, and the biggest one is Goldman Sachs tomorrow, 8 a.m. So Goldman will be very volatile. It might fall $3. It might fall, $4 or $5. It might rise $4 and then sell off. I don't know. So what I do is I rely on my charts. That served me well, and will continue to serve me well. So we're going to go through the Goldman chart because that is going to be determinant of how the market initially reacts the first part of the morning. There you go. Okay. So saying all that, let's go over how to read these Algo HFT charts and make it real simple here. First and foremost, you have this yellow dotted line, which is the pivot. Black boxes love the pivot. If it goes above pivot, big buy program, overshoots. Or the pivot acts as a magnet, depending on how far we've sold off. And how far we've sold off is determined by looking at the chart and the lines and looking at the internals of whether the overbought and oversold resets where they are. So let's start off with up here. So on the pivot basis, if the pivot acts as a magnet, as I've repeatedly said, let me go to the SPX chart. There you go. If the pivot acts as a magnet, then we are looking at, and here's the pivot, that's why I put the P. And on this particular platform, the pivots dynamically adjust themselves after the market opens. So the pivot that you're seeing here at 2274.94, which I posted a couple of times today, will shift tomorrow because the markets were in a lower, and of course we started to turn at around, look at the bottom here, at around 3 p.m. Nice bullish engulfing candles, reversal candles are forming. And so the pivot acts as a magnet, acts as a resistance, or can act as support depending on where we are. And I constantly keep on talking about it because it does, that's where it goes. So first thing when you look at this chart, look to see where the pivot is. If I don't put it in, I write it down, but you can see it yourself. Next thing you look at is the Bollingers. So the Bollingers are giving us a range of how dynamically these the S&P 500, which is basically the big daddy of controlling the markets. We all know that. How the SPX is, how it's situated within that within the trading range. So it just happens to be that the downtrend line here, this red line, that's the downtrend line, is almost intersecting with the upper Bollinger, which is around 2273, and the downtrend line is 2273.69. Now these numbers are, to me, very appealing because trading in between these numbers, I make a real decent sum of money. Am I right on every single trade, every 15 minutes on the S&P trades and this and the or the RUT trades or the QQQ when I put it out there? No. But buying a couple of contracts and selling them on a reversal, which I bought in actually and higher by the end of the day, is very lucrative. How much you buy, how much dollars you put in these type of candles and buying these reversal hammers, that's completely up to you. But I will suggest one thing: don't put too much, because these are extreme. It's like futures trading, and I know Reed here is a futures trader, and he can attest to the fact, I'm sure, that in a dynamic, volatile market, if you have too much money in these things, you're going to get whipsawed like nobody's business. So, and that's going to play around with your head. Whichever the case, you do what you need to do. I just show the levels where I think they are buy zones, and the risk reward is suggesting a move higher. Keep in mind that given the volatility in the market, these things can reverse very, very quickly. Okay, very, very quickly. So what I try to be is a little bit early on the initial signals and sell a little bit early before things get severely overbought. So first the pivot. Watch all these structural lines that I draw over the charts. Here's your uptrend line, which I generally connotate in blue or in white. Channels. Then you have a longer term downtrend line, which is this dotted line here. That can be used, again, that's also another downtrend line. Then you look at the red lines here, which are basically the supports. I even put markers, so it's easier on the eye, and you learn how to train your eye to look at these things. This being a 15-minute chart or a 15-minute time frame, there's going to be more noise. The longer the time frame, as you all know, the noise is lessened. The shorter the time frame, 5-15 minutes, like looking through a microscope, right? You're going to see things moving. You look through a microscope and something, you see a lot more weird stuff than if you're looking through a binocular, where you're looking at it from a longer perspective, right? Broader perspective. So the closer you get with the time frames, you're going to see more noise, and you probably will do more stupid things that you would normally not do if you were tracking the 1-hour chart. Whichever the case, the structural lines are the downtrend lines, uptrend lines, Bollinger's, pivot. The green lines are overhead resistance, i.e. upside. The red lines are supports. And of course, given the fact that I've been trading off these charts as one of my tools for many years, these things are just, it's almost like they're kind of built into my brain. So I see them more clearly than somebody new looking at it, and all they see is just a bunch of little things going around. But over time, you can train your eyes to really trade off these charts, just like any other thing. Let's look at the internals for a minute here, which are extremely important. Simplest way to look at it, we'll keep it real simple. This is obviously a 15-minute, so it's a shorter time frame. But even on a 15-minute, this reversal, for example, came off. This is the fast stochastics, the top column. When it gets this oversold, we're coming close to a tradable bottom. However, if you look at it, we got deep oversold here, right there, at around 2:15 p.m. Markets went down. We had some running tails right there, but there were three consecutive lower hammer reversals. I'm sure everyone can see that. 1, 2, 3. Yet it went lower. The SPX went from 2266 to 2262.75. Roughly about 3 points. A little less than that. Okay, from this point here, 2.75 lower. Yet this was telling me that that there were buyers all over these as we were sliding lower. We also slid out, had the Bollinger Overshoot, which I would say a good 100% of the time, depending on how fast it overshoots, you will get back in the Bollinger, even if it's a short-term dead cat bounce. And that's exactly what happened. Now, in tandem with that, I noticed that the fast stochastics were deeply oversold. And as we were making slightly lower lows on these on these hammer reversals, we had the fast stochastics were actually climbing higher. So that was a positive divergence right there. And this is what happened. So buying those 2275s, the January 20th 2275, the Friday ones at around the low twos, $2.30, $2.40, $2.30, $2.40, they closed. The last closing print on them at 4:15 p.m. As you know, the S&P options trade till 4:15. They were at 320, and the spread right now is basically 280 by 370. So if I wanted, I could have sold them after hours for a nice little gain. But all because I was looking at this thing here, and this I do every day. So you can trade that if you want. You can close your position out before the market closes. After the market closes till 4:15 p.m. If you want to scalp 60 cents on a bunch of contracts, that's money, especially when the contracts are cheap. So from 225 being the low, 224, they closed at 320. Not bad, right? On a percentage basis, you're looking at roughly 80 cents. I'm sorry, what am I saying? 80 cents. $1 on 2.24, you're looking at 44.6% if you want to do just hardcore numerical ROI. You can take 40% of that off the table if you wish. So that's your fast stochastics. What I specialize in is looking at the slow stochastics. The longer the time frame, the better. This being the 15-minute, look at how nicely the slow stochastics turned around. Once the slow stochastics gets below 20, remember, stochastics are simply the first derivative of relative strength index, right? The RSI. So that old saying, buy below 20, sell above 60, sell above 80, Some traders still follow that old rule. It's not as easy as before, but it works. So here it went below there. I started to see the turn, saw the crossover. It's starting to look good. And of course, on the slow stochastic side, the point where you want to basically sell all your position. Now that also depends on the markets. I'll get into that in a second. Is when it gets overbought. That's between 80 and 100. That's why I put the marker here so you guys can, see yourself. And when you get overbought, and this was just last Thursday, here was the point of maximum aggression, 2250 or so, 2254, and I pointed that as precisely as anyone can ever do, humanly possible. You got the massive run up, and the stows stayed above 80 and moved sideways. That's a sign of strength. But at one point or another, they would reset, and that's exactly what they did on Friday late afternoon, right there. Everyone's freaking out. I showed the gap, saw the reversal candle, went in hard. Very nice. Very profitable trades. And the slow stows were right there in deep oversold conditions. So again, you don't need to be a technical genius. Like I like to remind everyone, I'm doing all the hard work. I'm showing all the stuff. That's my job, my responsibility as a content provider on Clue to Save Trading. So all you have to do is understand it, make your own decision, and act on it. You don't have to do the hard work of figuring out the nuances of these things, but you need to understand what you're seeing in front of you. So here we are, closed the gap, took off. So now we're back there again. So at this point, it gets overbought. We don't know whether it's going to move sideways like it did here. Those sideways all obviously happened, you know, through during the day, all through the day. So we don't know whether you're going to take this and it's going to hit here, which is a point of, obviously a point of what I call the DT line, downtrend line resistance. Then you have the pivot magnet. If it breaks above pivot, then the market's going to attempt to again go back to that 2278, 2279 level. And keep in mind that the highs on the S&P 500 right now are tagged at 2282.10, right here somewhere, 2282.10, right there. That's where you have the marker. So is it possible that the market basically goes up here, hits resistance, and then rips up again and hits 2282? Not necessarily tomorrow. By Friday? Absolutely. Absolutely. That's a possibility. But in between that, there are going to be resets because the fast stochastics moves much faster than your slow. So the fast could come down and kind of reset down here a little bit, maybe come down all the way down here. I don't know. I don't think so, but who knows? We might get that first thing in the morning, come down here and create a W pattern known as the Dragon Bullish. Very, very possible. Maybe that's on the Goldman earnings, for all I know. This dotted line here is the next level of support, 2261. But the fast stochastics now is overbought as we close the day and will reset a bit. The resets could be from, you know, halfway down from the 50 level. Doesn't have to come down here below 20. But I'm going to be watching the slow stochastics very carefully and posting my charts. And I know a lot of the times I put big arrows there, so you know I can't make it any more easier. Believe me when I tell you. Okay, and if this curvature and this the trajectory of this is still pointing higher, because these are very sensitive to price movements, very, very sensitive to price movements, and to me it's second nature, and one eye is always looking at it. So these things, you know, can flicker around a little bit, the stow lines, the percentage K and the percentage D, but as long as the movement is curling higher, what does that tell you? That tells you that it's okay to lower my cost average, or it's okay to stay with the trade. Okay, so that is trade management. It's not where you enter, it's where you panic, and how long you hold it determines your profits. You all know that better than I do. So what the charts are doing for me is they are simply giving me a little bit more confidence in my trade management abilities. That's the bottom line answer to why I rely on my tactical charts and the way I structured them, meaning the lines I draw on them and the patterns that I see in them. All they're doing is giving me extra trade management confidence, which allows my mental sanity to remain more calm than the rest of the retail traders out there. That doesn't mean that I'm supposed to feel good when something is down a bunch of money, and the bigger the position, the crappier one feels. But if I can see that the technicals are not indicating a massive breakdown, despite the fact that these weird candles today in these days just appear from nowhere, at least it allows me not to do stupid things. It's a very simple theory in life and in trading. The lesser stupid things you do, the less you panic, the better off you will be. And that also takes into account that you always should be worried about your trades. Anybody who says that a trade is easy, anybody who says, oh, you know, I was kidding around with our good member, JB today. He said it's fun. Hey, I love doing what I do. This is my passion. I make a lot of money doing what I do. But it's never fun. When you think everything's fun, that's exactly when the markets hit you. It's like a JDAM dropping on your head when you're out there partying, right? And a war zone. The market is a war zone. And you're the Marine with a mission to take that territory. So don't treat it as fun. Treat it as tactical warfare. That's exactly what it is. So I see traders getting all excited and giddy and stuff, oh, this and that. And right there, the market turns. Why? Because it's not just you. It's the 100,000 of you replicated in a behavioral ripple, right? Across the board doing the same stuff, chasing prices. And the algos see that and they come in and put a jackhammer to the party and break the ceiling. That's why you need to always be aware, always be trading with one eye behind your back, at the same time looking forward. And the charts will only help you manage your trades better. I don't need to tell you anymore. You know what I'm saying. So let's take a look at the same picture here on the SPY on the hourly chart, because that will give us, that's better. So here's a clean chart of the SPYs. That was a 15-minute, right? So the 15-minute will reset and move faster than other things, as I explained to you. So here's a hourly chart. The markers are as accurate as you can get. You've got the Bollinger range, 227.42, 225.85. You got this big sell-off here, which ended at around 3 p.m., at 2 p.m. actually. You got the reversal candle that started around 3 p.m. I put out a chart on at the end of the day, which showed some big buy volume that entered the market on the E-minis at around 3 o'clock. That reminds me of a very important point, especially for newer members. You have to look at this. Well, certainly review the tactical charts being put out during the day. I mean, that's to your benefit, okay? Because I already know it. You know, I'm doing the hard work of putting them up there. It's not that easy in the middle of a very busy trading day to post those charts out there. But I'm doing it, so make advantage of it. But what's also very important is at the end of the day, when I put those closing views, take a look at them, because that's how you become a better trader, more efficient. Look, some of you have more skills than I do on the way you on certain things that you trade and the way you do it. All I'm saying is utilize my experience, hard-earned experience, hard-fought experience that I'm putting together in these visual charts, and just the combination of what you know, what you do best, and that is going to, you're going to see a major difference in your P&L. No question about it. Which brings me to another point. If the markets are very volatile, you don't necessarily need to trade all day. You hit a couple of nice trades, let's say a couple of SPX trades, or Tesla shot up because, you know, like it did this morning. I took out some very nice profits, and then I rebought back later in the day. So you don't have to hang around. Don't blow your P&L by forcing yourself to trade. That's what traders do. I've done it. I don't do it anymore. Is to overtrade and give back everything that you made, let's say the first part of the day. I don't need to ask anyone if they've gone through it. I know they've gone through it. If you're an active trader, or you're trading with an active portion of your book, then if you've made some money, get the heck out of Dodge. I know it's hard to do because you have time in your hand, you're doing this, you're like, I can make that other trade, yeah, and then it doesn't work. And then at the end of the day, your P&L's red, which really doesn't matter. If you're setting up swing trades, if your P&L is red, it really doesn't matter. I repeatedly show that, because within the next 24 to 48 hours from deep oversold conditions, which we might be getting to right here, which I'll go into it in 2 minutes. Look at the slow stows, okay? You could be setting up for a shoot the fish in the barrel moment where you just basically, you don't know where to sell because things are just ripping up. But just a helpful suggestion. If you're up on something nicely, your P&L's looking good, whatever, just sell it. Money in the bank is beautiful. Yeah, it shoots up a little bit more. So what? You got money in the bank. You can always re-enter another trade. So I find that to be extremely helpful. I'm just sharing my own personal thought process out there. Now, sometimes I regretted it because I sold a little bit early and things have just overshot. Happened to me on the last leg of the Amazon journey, even though we did so well. So I went in and bought the lottos, if you remember. And those lottos worked out fantastic. Because if you have, let's say, $4 options, which are at 9, 10, 11, 12, 13, 14, 15, why do you want to leave so much money on the table? Roll them out. That's when, and you want to play them nice and small, where small gets big, you buy the lottos. So if the lottos blow up, you don't get hurt. You get pinched. You don't get hurt. You get wounded. But if you leave your big positions out during severe overbought conditions, you can rest assured you're going to lose a chunk of your money. And I know a lot of you have gone through that. So try not doing that. It's just a suggestion. So let's take a look at what's going on here. To me, it's a very structured chart. You got the lines here, upper resistance. You got the Bollinger Band here at 227.42, which also happens to be at R1. This first green line is R1, resistance 1, upper resistance. So that's at 227.43. What I noticed was despite all this volatility, and I'm going to ask this question, and I'm sure one of you will answer me that, through all this volatility, okay, that we're incurring, this is like chop fest, even though it's an inverted head and shoulder with the head down here, left shoulder, right shoulders, multiple left shoulders. See that? There you go. So it's still intact. And here's your neckline. Now look at this carefully. Through all this, and I'm going to give you a hint, look at the lines. So through all this severe intraday volatility since the beginning of the year, this was the beginning of the year. The head was the beginning of the year. How beautiful is that? That was January 3rd, right? Till now, which is 18 days later. Well, it'll be 18 days tomorrow. What do you see happening with all these lines? Can somebody tell me? Overall, the major lines. And you know what those lines are, right? Anybody who's a chart reader should be able to answer that. So I'm waiting for a response.
They're becoming pinched.
That's one way of answering it. You're close to the answer, but that's not the exact answer I'm looking for. Go ahead, give it a shot.
Between the yellow lines, you've got a channel, but you also have an expanding wedge going farther back.
Okay, now you're going way too overboard. It's a simple answer, which I'm not going to give yet. First of all, look at the lines here. I always use by default. The orange line is the 34-day moving average. The red line is the 50-day moving average. The red line here. The yellow line is the 5-day moving average, which is obviously very sensitive to intraday movements. But those are the three major moving averages that I use on a consistent basis. The 34, 50, and the 5. So the major ones obviously are the 34 and the 50 because they are carrying a longer, their weighted average of a longer time frame. So who didn't, somebody else who didn't respond, can you please respond to what you see in those particular moving averages that I just pointed out? I mean, I'm almost giving away the answer.
3450 cross, almost cross.
Nope, incorrect. 3450 cross happened here. That was the first sign that this market was going to go higher. You see the 34 crossing over the 50?
Mm-hmm.
The point I'm going to make here is a very simple point. It's going to help all of you. So who didn't answer yet? Just step up and answer. This is not like, hey, if you don't answer, you're going to be put in the back of the, back of the classroom. So because that's what these webinars are about. You see these very simple things, and believe me, you will see a substantial increase, in my opinion, in your P&L and the way you handle your trades, and you won't freak out. So who didn't answer, please step up and just tell me. I'm going to move all these. I'm going to delete this thing here so it's cleaner. Because if you don't even attempt to answer, then you're defeating the whole purpose of what you're trying to do. So, Brian, did you answer?
Yeah, I said they were getting pinched.
Okay, good, good. You're actually the closest to the answer, Corey? Corey, you there? Jeremy? Okay. JP, you there? Okay, JP. JP answered. JRW? Jesse, did you answer? Jesse, you there? Okay. Reed, I think you gave a response, right?
Yes.
You responded, right? You mentioned what was your answer? Or response, I should say. Or read.
I thought they were crossing again.
Crossing again. Okay. And Steve, you mentioned what was your response?
I was the one who said we're in a channel between those yellow lines you had up there.
Yeah, that's a given. I mean, that's a fact. JP had the right answer. My good old buddy Jeremy, who I always hear busting his chops, that he's always watching prices. He had the exact answer. They're not rolling over. What they're doing is they're moving sideways. Watch. That is an indicator of underlying breadth and bull market strength. Okay, correct answer. Good job, JP. So bottom line is that the moving averages, the 34 and the 50, which are the first signs of a protracted multi-day decline, are not rolling over. They're simply moving sideways. Yes, you can squint your eye and say, yeah, we have a minor crossover, but just the first visual that you look at, they're not doing this type of stuff. They're not doing, they're not like sweeping down. They're moving sideways. So that I'm on my second CPU, so I can't show you that because on the Warden platform, which is freestockcharts.com, I used to show this all the time, that despite Brexit, and a lot of my video casts explain that despite Brexit and despite the junk bond yield fallout and blah, 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 rate fears, the moving averages overall on the daily still kept on moving sideways. What gives? That means the real weighted average of the prices were not collapsing. So the fact that they're moving sideways, and of course they can change, but I'm showing you what's in front of us, is a pretty damn good indicator that the market will have at least try to attempt another spike in between all the stuff. Okay, so that's a positive that I can see right there, moving sideways. All right, thanks, JP. So now let's take a look at the underlying slow stow, Mr. Slow Stow, as we like to call him affectionately. Somebody's going to say it's a she. I'm like, I kid around and say, why is it a she? I'm like, okay. Is it Mrs. Slow Stochastics? I don't know. All right. Stupid joke time. So bottom line is that when you look at this here, visually, the first thing you look at when I'm showing this Slow Stow and I put an arrow or I don't put an arrow, the first thing you do is where are we with this? So this hasn't turned yet, but it's getting to a level where it looks like after the initial jerkiness of the first part of the morning, and that's going to be due to Goldman earnings, okay? And don't forget what Goldman did last time, if I remember correctly. It fell, then turned around and just decimated the shorts on earnings, okay? So the thing is that it looks likely that we are going to possibly slip down a little bit more. Now, all this can happen during the night because the futures, which are down flat right now, they're flat. They're down 50 cents. 50 cents, right? 50 cents, all right. The E-minis are down 50 cents. So what if they were down 6 by 3 in the morning or by 4 when the European markets open? By that time, this will already have reset overnight. That's why these dynamic resets on the E-minis can do the resets while, off trading hours, off normal trading hours. So bottom line is that this particular platform does pick up after hours movements. So the first thing I do in the morning, and I get up pretty early because I look at a whole bunch of stuff. And sometimes, you wake up like 3 in the morning, you're just looking straight in the iPhone. I go, okay, what are the futures doing? What's the European markets doing? The bottom line is that they're close, but they need a full hard boot reset, and a hard boot reset like this would be very welcome. These are the points, repeatedly, are a point of maximum aggression on the long side. And these are the points which are the toughest because it bottomed here, but the market still went down more. But then it moved sideways, digested all this fall. In this case, it went from 223, fell another 10 S&P points. And then right there, it starts to turn. So somebody like me would not buy the first initial, and this is basic trade stuff that I do, just my stuff, I wouldn't buy the first dump. I would like to see a small turn, like it was starting to do that. So I would be buying my first lot here because I see the turn. Then the turn materializes into a sideways movement for the next hour. This was on the 29th, by the way, on the 30th December. So so then the 30th and 31st. So it's still moving sideways and it's still slipping. So I would buy a little bit more here because I don't know exactly at what point the hammer reversal is going to start, which it certainly did. Which it certainly did at approximately, look at that, look below, 3 p.m. So if somebody says, oh, I know exactly it's going to start at 3 p.m. No, because this wasn't a full-scale hammer reversal. This looks similar to this. But look what happened between 3 and 4. A bullish engulfing where I bought more as the bar expanded. Of course, there's an element of luck involved. And on January 3rd, S&P opened up almost 18 points higher. $4 calls went to 13 right at the open. And then continued higher till it reversed from nowhere. There was no point of reference here saying it was, other than the fact that it got towards well, at that time these lines were different, and then it started to slide. So that's what algos do. They don't raise a green flag and says buy me, buy me, buy me, or a red flag and say okay, time to get the heck out of Dodge. No. It doesn't happen like that. Okay, it doesn't happen like that. So that's why reading these charts is extremely important. So right at that point, because that cost average down, I can't remember off the top of my head, but I think 5, then I bought 3.5, then I bought 3. My cost is moving down nicely, and then see you later. I could have sold right away at the close, but I made a tactical bet based on what I'm seeing here with this turn that at least I would get one bump up. Little did I realize I was going to get an 18-point bump up, but 6 or 7 points would be good enough for me on the E-minis at the open. So that's how it works. I'm getting the simplistic way. So saying all that, I'm liking what I'm seeing here. This, I'm warning you, could possibly slip a little bit more, but I would rather be buying on the lower end of this risk-reward ratio where my risk is being minimized and my rewards are building, and then wait for a sharp move higher. Because this will happen. Just the way on Amazon when I showed what could possibly happen, and on so many of my forecasts I've shown things and they have happened. It's not a joke. Forecasting is not like, it's not easy business, believe me when I tell you. So if that was the case, then all the gurus on all the other forums would all be great forecasters. I don't see too many great forecasters out there. Smart guys, shitty forecasters if you ask me. Choose my French. And forecasting equals money. That's it. So bottom line is this will happen, and if it does slip into that deep sort of 20 mark, below 20, would be more of an aggressive buy. So I have a couple of calls. If I see it sliding down, I would be buyers, and of course, I point those things out. So looking at this chart here, we are still seeing a complex inverted head and shoulder that still seems to be holding. We could even do this. This being the left shoulder, we could still come down and test this uptrend line again, and then make a move like that. Now, when does all hell break loose? Like things are just not going to come up. It can happen. It could be a tweet. It could be something stupid coming out of Europe, or the Chinese did something stupid. I mean, whatever the case may be. So in that case, if I see the break of, again, the first support right here, then the second support, and there's no reversal candles, nothing in sight. If I see this break, I'm shorting. So I'm buying S&P puts as a hedge. Okay? Remember, things are very fast. So you wait around 5 minutes, it's too late for the trade. You wait around 3 minutes sometimes. If you're in front of the screen and you're hesitating, you're not making money. I can't do anything about it. It's just the way the markets move. The machines move the market. If it moves here and doesn't see any semblance of a inverted, of a hammer reversal or any type of candle reversal, then it'll slip here, and this channel better hold. Anything below the channel, you don't need to be a technician to figure out that this is that wide channel that the market's trading in, right? This is that wide channel that the market's trading in. If we get there, like we did here, and we don't turn, then you got a nice fat fall all the way down to filling this gap and possibly a retest of going back to January 3rd and December 31st. Am I clear on that with everyone? Yes? Did everyone understand that? Because I kind of made it very simple. Yes? Okay. Now, if this, now you guys don't have quad. Well, some of you do. I know some of the people who are using it, but that's why I'm posting these charts on a quite frequent basis. And after tonight, I know you guys will be reading it much better than you did before. The fact is that we don't know whether it's going to do that. And if it falls here and doesn't break, it's going to make a killer move, which could be equal in magnitude and size to this move here. So let me just get this out. Let's do this fat candle. Okay. Right? That's range trading. Algo style. Okay? So bottom line is that just because it falls here, now if it breaks here, the chances of it hitting the lower end of the channel, if it doesn't hold the support, are pretty damn good. That's a very decent sum of money on the put side. Intraday puts probably $2, $2.50 will probably be $6 per here. Not 6, probably be 5. You can probably get 100% move between here and there, because that's quite a sharp fall, or at least a 60 to 70% move. We can play that. Now, if it does do that, which is a possibility, mind you, this will be in really deep oversold zone and moving sideways, similar to here. And if it holds and starts to turn, believe me when I tell you, high probability trade, you're going to make a substantial move from here to here, which is almost 30 or 25 S&P points. And if somebody tells me, no, that can happen, well, they're not traders then. They're just paper trading or whatever they're doing. Because I've seen it happen over and over and over again. So those are, again, remember one thing that I keep on saying, and I mean this. It's not a game of certainties, okay? If you think you know about a certain trade, the only real, and I said this a couple of weeks ago, the macro trade that I was pretty certain about. Can somebody tell me what it was? And I explained that very clearly, that that I'm pretty certain on this swing move on this particular asset class. What was it? Come on, wake up, guys. Somebody tell me.
Gold.
Yes, exactly. And it's doing exactly what I'm saying. And now it's getting severely, not severely, but overbought. Gold, exactly. But when it comes to S&P and stuff, forget it. We're in a primary trend still up. We're getting corrective tactical consolidations very rapidly. That's it. So that's how you read this thing. Now let me switch my screen to my other thing that this will take about a second for you guys for your screen to refresh, but let me know when it's done. Did your screen change?
Okay.
Yep. It changed to the
investing.com.
There you go. Somebody wants to play the fly, not pay the piper, because I always believe you got to spend money to learn any craft. But somebody wants to play it on the cheap. Buy a knockoff, Gucci or a Hermes or a Prada, okay, from right on Fifth Avenue. If you're a New Yorker, you know that. Or if you're a tourist, you know that, because that's what they do. They keep on buying the knockoffs. Right next to the big Hermes store. How beautiful is that, right? Instead of paying a crazy frigging mortgage to buy a $15,000, $5,000 handbag, ladies bag or whatever the case may be, you're buying it for $50 right next to the store. That's New York for you. That's why there's Donald Trump, okay? All right. So saying all that is you got, you want to play cheap, investing.com. It's free. Just register for it. You don't have to pay for it. This is one of the most dynamic chart systems I've used in a long time. And you can see it. And they're giving you free real-time stuff. I mean, that's pretty damn good stuff. Yes, it doesn't have the nuances of the indicators and such. Yes, it has, but not as advanced as Quad, but it's free. So use it. So when I show these things, first thing in the morning, what I do is I draw out the pattern. I draw out the basic levels. That's it. And you can see how mathematical they are. So there's this consolidation channel that I talked about, which started off on the 13th, which was on Friday at 9 a.m. And then this, right? So this was a consolidation channel. Yes, okay. So there we are. It's not that hard to read. So if you look at this consolidation channel, the two things that'll happen. One, it's going to break out and hit this level here. What's this dotted line? It's the downtrend line. That's why it's in red. Or it's going to break below this uptrend line that starts off all the way at 22.27. That's 22.32 or so. This is E-minis. These are the ES, right? These are the actual futures. And so you got to add like 5 points to it or whatever to the actual number. So right from the 22.32 level or so, back in the bad old days of December 31st. What was the last trading day of the year? December 31st, right? No, December 30th. See, I'm losing my head. December 30th, yeah. So December 30th, right down here. So you are either going to go higher, hit this level, and it's going to be, it's going to be, every candle is a chop, so fine. But it's, to me, it's looking good so far. Or we're going to break down and we're going to hit right here. Look at that massive reversal candle that happened on the 12th when we bought in and everyone was freaking out. And that was one heck of a trade. From 22.48 on the E-minis, we jumped up in 3 big, fat 4. 1, 2, 3, 4. We hit 22.66. That's a trade. Catch 20 points like that. Now, you don't know whether the third candle is going to develop, but here's a trick. Once you see a reversal hammer, and then you see an expansion candle, that's an expansion candle, which is almost equal the size of the previous drop when everybody's quiet in the room and scared and whatever the case may be. You know how it goes. You know that the pattern symmetry, that it's going to be a high probable pattern symmetry move higher. And that's exactly what happened. So when traders wait around and try to buy here into the third expansion candle, yes, they get a little bit of a bump. Then what happens? Chop, 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 and then they freak out, and then they leave it, and then they see it, make another move. That's volatility. Algos know where your stops are. They know where the traders get excited. They know pretty much everything. It's artificial intelligence. So get used to it. Can't hide anywhere. They're watching you. I mean it. They're watching you. That's why you feel like somebody's out always there to get you. It's like when you were a little boy. You think everybody's out to get me. Yeah, they are. It's called Algo HFT black boxes, devised by a bunch of quant, real smart guys and girls who have no idea how stock markets work. They just work with numbers, dynamic momentum numbers. There are day trading algos, there are macro algos, there are swing algos, there are all kinds of stuff. I have some great articles on it on my website. Read them. So once you see an expansion candle, you know there's going to be a follow through. So if you don't even buy here, fine. You don't always have to be at the bottom. But I would take a small position of these levels. And then you see, but then this is the most indecisive one. It keeps on going, like when it's developing, it just keeps on going, you know, it red, green, you know, you're not sure what's going on. And then the second expansion candle starts. That's when the shorts get bamboozled. That's why you get this big move. Third one is normally a small one because this is where I'm taking a lot of my profits, leaving some out there. And then I see the fourth one develop. So you normally hear the wowzers and the kabooms somewhere in here. We should be hearing the sort of the primal yell of traders because they're making some serious money from this level, not here. Because by this time, this could easily fall. And then just like, you know, it could go straight up, you know, fall. This is another support level, but it didn't. It continued like that, sideways. And this sideways chop is no good because options move around like monkey on a hot tin roof, and you feel like, oh my God, where's it going to go? Where's it going to go? That's why these charts are so important. And I use investing.com a lot. Get your eyes trained into looking at these candles. Once you understand candle dynamics, and there's no way to predict candle dynamics, there is way to predict patterns. Not individual candle dynamics. In this case, in that case, you're beyond the robot. I should hire you then, okay? Because I can't even read candle dynamics when they're moving like this. So this pattern is showing me that the consolidation channel is still intact and that we can move higher. Now remember, everything that's happening here, ladies and gentlemen, is going to affect your trades on the other side. Yeah, we're gonna have some powerful contra trades like PNAW or Clovis or something like that, which is going against the grain. But that's few and far between. Most of the Googles and the Apples and this and that are trading with the S&P. Yeah, some days the S&P is a little bit weaker, the techs are stronger, but even then. So if you know how to read these things, it's not just for SPX trading and SPY trading, it's for your trade management. That's what I keep on saying all the time. So again, I don't want to hammer that point in too much before it gets stale, but please try to understand this so you manage your trade better. It's not going to be easy. Easy doesn't make big money. Tough makes big money. Stress makes big money. All right, that's the same thing in life. So anyway, so bottom line is that at this point, you're going to either come down and test this, in which case you would create a massive, if it holds, because it could slip here, and again, like I showed you on the other chart, it could fill this gap. That's at 22.36. I'd be buying pretty nicely down at those levels because there will be a reflex bounce. Why? Because the internals would be heavily oversold. Anytime internals get heavily oversold, it has a reflex bounce. Can somebody tell me why? Think of it in a very simple manner. When certain indicators get deep oversold, why do you always, 100% of the time, get a reflex bounce? Anyone? No one?
Well, when it's oversold, people are taking their money out, profiting, and then it'll drop.
No, when it's oversold, who's making money? You're almost there, Brian. Who's making money when something gets really oversold?
Yeah, the algos.
No, the shorts.
Oh.
Yeah, the algos
Shorts
would
tend
be
to
short
cover
too.
them.
So basically, just like a long takes money because the price goes higher, a short takes his money and runs when he covers at the lower price, correct? Did you understand that simple concept? If you shorted something at 10, okay, like when we buy S&P puts and they shorted something at 10, let's say stock, and it's down at 6, that is a 4-point, that's a 4-point gain for you, correct?
Yep.
And what do you have to do at 6? Do you buy? You buy to cover, right? You sold to open. When you short something, you sell something to open the position, correct?
Yep.
And then at the bottom, you buy to cover. So when you're buying to cover, that creates a reflex bounce, also sometimes known as a dead cat bounce, because the smart shorts who basically shorted on this break, or let's say committed shorts who said that's it, market can never go higher, and it worked on their favor, and they shorted hard at the upper end of the channel, they'll be covering at this major inflection point, because that was the last time where the market turned and burned the shorts, right? If they didn't react fast enough. So that's the simple concept. Every trader, which most of you already know, that's why reflex bounces happen. Things get deep oversold, the shorts are going to cover, or let's say whoever, let's say a good number of shorts are going to cover, take their profit, wait to see what happens, and that initial covering creates a reflex bounce. Do you understand what I'm saying?
Yes.
Did anyone not understand? I mean, this is like basics, but that's good. Quite good, you got it. So that's why you get reflex bounces. Every pattern is nothing but a manifestation of human behavior. It's simple as that. Freak out, freak in, too happy, too sad. So that's it. So anyway, so this is where we are. So using this without hammering it too much, always please spend 5 minutes. What 5 minutes? Takes 3 minutes, 30 seconds. Look at the channels, look at the lines I'm drawing. Maybe write down the numbers down, and then best thing is that you have that in front of you. Just have somewhere one window open with investing.com. Believe me, it's going to help you a lot. So the same thing here. So I did this morning. This is a megaphone. Lower end of the megaphone was touched. Double bottom. That's a triple bottom of this multiple long tails. So here's your support. You could fall into this. We could fall into this tomorrow. But this is looking good. The megaphone, if the market does want to go higher, you are going to see a move like this. And here you're going to find major resistance because that's the downtrend line. That's the downtrend line. If it breaks above that, it doesn't break in a straight line. By now, just get that through your head. Nothing breaks up or down in a straight line. Probably zigzag around a bit. So that's why I draw different lines so that people can just use them as reference point. And if it does this, it does this. Otherwise, it's going to it's basically going to break down. And that would be, in my opinion, a pretty solid buy point. This being a 1 hour chart, you can see here that the stows, these are fast stows by the way, are starting to move up. Final chart that I'm going to show people, which is Goldman Sachs. That's going to be the big granddaddy that's going to dominate the markets tomorrow. Let me change my screen. Bingo. I'll walk you guys through this. Is everyone still with me, or did I lose some people? I mean, lose everyone here?
I'm here.
All right. So let's go Goldman. Love trading this chart. Generally not good at shorting this baby. Did it once, did well, but I like playing the long side on this. Too powerful, like I was half kidding around. We got powerful, multiple major Goldman guys within the new administration, right? You guys know that. Don't mess with Goldman. So I don't think they're going to completely damage the market right before the inauguration. There's always a hidden hand somewhere, all right? The whole system's rigged. It'll always be rigged. Life is rigged. Let's wake up. Face facts. Like I say, you want fair, go to a circus. So the bottom line is that, or go to a fair. Okay, so there's Goldman. Very tactical chart. You can clearly see that Goldman is completely run by the algos. I don't need to explain anything. Just look at these patterns. This is Goldman going back to the end of last year. I have it down to a science, at least on the levels. How you trade in between is your job. So this is pretty clear that this level here is a point of, I consider to be strong support. We slip lower. There's a very wide Bollinger movement. You can see here because of the slide today. down 3%, 3.5% almost, right, Goldman? Not bad. So this is the time frame that I'm operating in. I'm not going back years, and I'm just looking at this time frame. And this time frame is telling me that we could slip as low as 234. I can handle that. 2 points. I have a few contracts and some common. I'm not gonna die. And if it goes, it goes. I can always cost average down if I see the turnaround. But you can clearly see here, this being a very algorithmic chart, that what is about to happen. Goldman could slip. That's 237 roughly after hours. And you know what's going on here? I'm going to show you something that'll freak you out. My screen just came alive. My code screen just started blinking like no one's business. I saw this happen once before. You guys ready to get freaked out? It looks like the market's trading. Watch. Are you guys ready?
Yep.
All right, get ready. You never see anything like this, all right? Look. Can you guys see? Can you guys see?
Yeah, we're on the screen now.
Do you see what's going on? What time is it now?
It's 8:45.
Exact. It's 8:45. Why the heck is the screen doing this? Does it look like there's live trading going on? Man, you guys are work of art. I mean, say yes or no. Does it look like there's live trading going on?
Oh yeah.
Exactly. I don't know why this happens, but I've seen it happen 2 times, 3 times in the past year. All right? So that's crazy. The screen shouldn't be lit up like that at 8:45 in the evening. It's just going nuts, berserk. There's volume changing. But anyway, this is what happens these days, right? It's like, anyway, we want to get into that now. There's a reason why that's happening, but I will not cover that tonight. So just wanted to show you guys. So Goldman, I'm on the wrong screen. Hold on. There. So let me just finish up with the Goldman thing. This chart is very readable. You got the pivot at 242, which coincides with the downtrend line at 242. If the stock makes a move of $6, it's going to hit 242, hit a major roadblock. At this roadblock, it makes a decision whether to move higher, hit the second downtrend line that was generated from the 246 level, and that's at 244.50. If it takes that out, you can rest assured that Goldman will hit 248. Now, Goldman going up 12 bucks, I haven't seen it happen. So I'm not betting on that. Can it do that by Friday? Sure it can. Best I'm hoping on Goldman is a move of $5, which will obviously push the market up. Goldman itself is what, 20 points on the Dow, or 10 points on the Dow. I can't remember, but it's 50 to 60 points on the Dow. Will just be Goldman. Generally speaking, from this major inflection point, we have always seen surges. I don't see any difference this time. However, it's earnings. So if it croaks, we're going to look at 234.31. Beyond that, we're looking at 230 as a round number. However, by now you should be staring. What's one of the things you should be looking at when you're looking at this chart? You should be looking at the underlying indicators. The fast toes. Look at that spike. That's a capitulation type of candle. I like it. 1.5 million shares dumped. It's called stops going off. I like capitulation before earnings. Okay? It's a good thing. Fear. Get the hell out of Dodge. Whatever the case, Goldman could be lower for all I know. I'm looking at lower Bollinger, 234.32, and I explained to you what I see here. That's a large consolidation channel, lots of bars. Pattern symmetry dictates that it's going to at least go up to 242 if it wants to go higher. This is what I like. I like this. I like the fast toes, which bottomed when the stock was at 238. That's when it bottomed. Then it started to move higher, what we call a positive divergence, and the stock went a little bit lower. So in other words, lower prices, higher internals, known as positive divergence. You can see what's going on. After hours, the stock closed at 1 second. This is 3 p.m. This is 4 p.m. Nice little candle reversal at 4 p.m. And then you're starting to see the movement higher. It's attempting at this point at 7 p.m. It was attempting to enter this wide, broad consolidation channel or downtrend channel. I don't know if it's consolidation channel. It could be a downtrend channel. This I like. This I like. The slow stows are starting to turn. If you squint your eyes, you can barely see a crossover. Can somebody tell me, looking at this chart, looking at this indicator, when the last time we saw the slow stows down here? Quick, quick, quick. Come on, guys. You got to think faster. One thing about traders, you got to think faster. Look faster.
29.
Thank you very much. 29. 29. It dipped below the 20 mark on the 10th. I like it. It's oversold. Can it become more oversold? Absolutely. Absolutely. But I'm giving you the higher probability move is that it turns like that. And once it turns like that, it'll at least get up towards the upper end of the range. That means the stock probably hits here. The pivot's at 242. It's the pivot, the standard deviation from the pivot's pretty high. So it's likely that it tries to head back there. Of course, there are resistances along the way, including 239.50, including 240.41, whatever the case. If it does a full scale pattern symmetry, I mean the V-shaped reversal, you're looking at 244. End of story. Guys, any quick questions before I go? And feel free to ask me any question. I'm here.
Hey, Clue, this is Corey. I jumped in late.
Yeah, go ahead, Corey.
What do you think make the banks sell off as much as they have? You think they just ran up too much and
I believe but no, nothing to do with that. The bank sell-off came about because financial were selling off like crazy in England. That's it. You know, financial and the dollar. You know, the dollar, the tweet that the dollar is way too strong, which I explained earlier on in this thing, which I agree with, the dollar is way too strong. That's one reason. And then stops got triggered. Goldman started falling, but financials from Europe were getting hit on Theresa May's, you know, she gave a pretty tough speech on the Brexit thing. So the bottom line is on the hard Brexit, they call it. And, you know, it's almost hard Brexit is like a hard landing. You know, so the banks were the first ones to feel the heat. And the other reason why banks are very yield sensitive, right? So if you look at the TNX, the 10-year bond, which is another chart, the TNX today, basically, today was Friday. The TNX started falling from 2.4%. It basically came down and started falling again at around 1 o'clock. The TNX, I can't show you that on this side because it's on my other screen, but pull up the TNX on your screen, you're going to see how fast it fell. That's the other primary reason. When the 10-year bond and the other bond proxies, when the yield started to fall and money moved into the bond market, obviously that hit the banks, that hit the financials. So that's you know, that's the best I can think of. Morgan Stanley, I think, went negative at one point. I wasn't really tracking it, yeah, so there's some fears out there. There's some fear. And this, I'm seeing a headline here at 7:19. Goldman Sachs' compliance chief to step down. Oh, that's interesting. Not that it, you know. So I guess Goldman said, you know what, enough of compliance. It's time to go wild. I just see it at 7:19 on Fly on the Wall on one of my other screens. So in answer to your question, bond deals dropping. Anxiety out of Europe, those were the combination of factors, and general resets, you know, like you said, overbought, needed to. I showed that clearly. I'm showing it to you now. You know, nice deep oversold, but that was quite a sharper drop, so, you know, have to be watching it. But like I said, I'm just playing tactical. I'm playing, I know, if I get 3 points on it, my options are going to be up to about 60%, 70%. I'm out. Got a number of shares. You know, I'll just play along with what these charts are telling us. Any other questions? Brian?
Yeah, actually something really quick. So on the GS chart, when you're looking at the 17th, you see that the fast stock, it shoots up right in the morning where the slow stows kind of keep going down. So I guess only on certain trades will you play the fast stows.
Yes. There's no hard fast rule, but it's a very good question. The slow stows normally carry the most weight. So if the slow stows are still sliding down, you're talking 17. You're talking today, right?
Yeah.
Yeah, so the slow stows are moving just the way it moved here. We had a green candle, which didn't survive going into the Bollinger. The fast stows will move between quick, fast moves in the market. But if the fast stows are the slow stows keep on going down, that weighting is higher, more powerful, and it will pull the stock down. It's not a hard and fast rule, but that's generally how it happens. So sometimes when I'm, let's say, buying an S&P put, I might be like, I'll buy it and then all of a sudden I'm down like 30% on it because the market went up against me. You know, it happens a lot. But if I continue following the slow stow, I'll be dollar cost averaging on those puts, bringing the cost down, because the slow stows continue going down means that the market, whether it be next hour or the hour after, or possibly the next day, will reset lower. And so the slow stows carry more weight if you're looking for a more confirmed buy.
Awesome. Thank you.
Got it? It's a lot of dynamics that happen. There's no one single thing, but that's the easiest way to determine it on the slow stows. All right, guys. So listen,
Clue, one last question.
Sure.
Sort of like after hours tomorrow. Let's say tomorrow pre-market.
Yes.
All of a sudden you see Goldman Sachs falling. You just sit there and use an early indicator and see if there's any reversal candle that bounces back, before the market opens.
Let's put it this way. If the candles are as severe as it was today, then we have to swing out to the daily charts, right? So if we look at the daily chart, actually you can't really see it here. Let's look at Goldman on the daily chart. Oh, 1 second. This break here, which I have a lot of markers here, so I'm keeping it, but let me take this out. This break here, looking at it at face value is not good. See this big candle right there. So that's not good. I mean, look at that. But then what's not good also means that on the daily fast stows, we got deep oversold in one single day. Look at that. See what I'm saying? But that candle is a large bearish engulfing. So what I'm really looking for at this point is some sort of support to develop at the levels I just talked about, which is around 235. If Goldman breaks further lower, as you know, you said it yourself, you posted, if we got a major Bollinger overshoot, right? So either it's the start of something big, which I don't believe, or it is just a very hard reset, which is developing right now. So if I see the Bollinger Bands completely start to slide down like this, 1 second, like this, then that means the downtrend on Goldman has started, which means that we could hit that 220. There's a gap here at 210. So all those come into play, but I'm not that smart to project that hard that we're going to fall 25 points at Goldman. You know what I'm saying? It could happen in February. I just don't think it's going to happen now, unless the 25 points at Goldman means the market is going to be down 400 points. But I'm going to be watching the Bollingers and seeing if they're starting to stretch down. That means something's not going right. Here we're deep oversold. I expect a quick reset higher. That's what I'll be playing. I'll watch to see how the slow stows here on the daily, which are pointing down, but they were also pointing down here, if this support level is breached. So all kinds of things I'll be watching. Of course, not just this chart. I'll be looking at other stuff. And let's see what they say in earnings tomorrow. All right?
Thank you.
Yep, no problem. So I'll see you guys tomorrow. Jeremy said, can we see a quad chart? Think it goes a lot higher after ER. You always think it's going higher. That's Jeremy. I'm just kidding your leg, buddy. 1 second. Let's see here. I want Netflix to go higher. Okay, let's see here. Netflix. I have it here. All right, Netflix on the daily. Let's get these lines out of here. Netflix, these are the channels, all right? And my channel charts on Netflix are pretty damn good, JP, you know that. As long as we, track it closely and do it. There's nothing here that tells me Netflix is not going up to at least 140. Now, saying all that, it's probably going to crash down 100 points. No, I'm just kidding. So I am thinking upper end of the channel, pure from a technical standpoint, JP. We're looking at, that was JP's question, by the way. He wrote it at 142. That projects out to what I have here. Lower end is mid-Bollinger of 128. Lower channel is 122. And of course 112 if it completely collapses. But at least from what I can see here directly in front of me, in between the big swings we'll see is the pivot is not here. The pivot is here, right there, okay? Because it moved up. So the pivot is, you notice how it closed right above the pivot? It's amazing how these things work. Right there, right above the pivot, because that right there is the pivot. I'm trying to see. That's how I see the pivot. Okay. So there you go. So it's in the second channel, channel 1, 2, 3. It's on the third channel, JP. So that's what I'll be watching. I don't necessarily, this consolidation was fine. That's a standard 1, 2, 3, 4, 5 candle consolidation. Freaks people out, but it's okay. It's there. It came and tested the breakout, which was 129.35. And then right here. So I'm looking at the upper resistance here. R3 is 138.33. And of course, upper channel is 142. So that's really what I'm going at. If I see it completely, unless these Bollingers completely turn around like this, if it starts doing this, that means Netflix is on a downtrend and it's going to hit 112 again. Unless that happens, it's simply a matter of finding the levels. One is this, one is this, where the stock can bounce from. So that's your answer to Netflix. Good enough? Good. So let's see here. Awesome. So we'll connect tomorrow. Let's stay flexible. Don't go nuts with loading up too much on one side or another. This market's it's a difficult market. I'll tell you that. Okay. And but then at the same time, when was the market not difficult? The only time, the last thing I'll say, and this is for everyone to listen to. You're here when they listen to this broadcast. The only time it's easy to sell and take nice fat profits is when you position yourself at the right time during a difficult time. End of story. Okay, end of story. That's when it's easy to take the profits, not when you're chasing late and trying to make a few bucks. Have a great evening. Thank you for being here. Pass the word around, and God bless you all. Good night.